Welcome to the Winner's Playbook. Every winner needs a game plan, and this one's for you. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. I'm Billy Norman, here with my guest Eddie from Link Wealth Finance, a top mortgage broker and host of the famous Brokers Lounge podcast, which I'm sure you've all heard before. Big news recently, interest rates have dropped. So today we're going to break down what this means for your borrowing power, your mortgage strategy and your financial plan. Eddie, great to have you here.
Thanks, Billy. Thank you, man. And appreciate the introduction. Yeah, pretty much we're worldwide famous now with the podcast, going side by side with Rogan. So, yeah, can't complain. But
side by side with Rogan.
Yeah.
Yeah,
but
I think that's...
Man, I appreciate being on the Winner's Playbook, playing with the big boys. Yeah.
No worries. Great to have you here. So, big question to start with. Do falling interest rates mean that it's a good time to buy a property?
It's always a good time to buy a property. You're asking a mortgage broker. So, always a good time to buy a property. Like the say goes, you can't time the market. Just when you can jump onto it, there's definitely an opportunity all the time. But having said that, in light of the rate cuts, definitely this will influence markets in a certain way where a lot of people will get into the market, and then you start seeing movements, you start seeing higher demand. So that automatically puts a bit more pressure on prices, and that's where people who wait on the fence miss out. So yes, a rate cut means movement in the property market, and you definitely should be on the move if you're planning to get into the market sometime soon.
And you've seen, so this is the first rate cut we've had in a very long time. Have you noticed, like speaking with clients and people who are buying properties and so on, have you noticed like a change in their attitude?
Oh, absolutely.
Or how they're thinking about borrowing and buying property and so on?
100%. And to be honest, I think a lot of it is psychological rather than measured financial plan. It's just psychological. People straight away, most people, so we don't generalize, like they'll get that fear of missing out, and they try to, okay, we need to get moving now because they anticipate prices will start rising again, and that just creates that environment where everyone's just, all right, we need to do something now. And yeah, as soon as we seen the rate cut, we had a lot of clients who were in the pipeline waiting to buy literally on the same weekend they purchased something. So that says something. And then I was having a chat the other day with a client of mine who holds a very high position, and they've done a study once on petrol prices and gambling, and there was a direct relationship between the cost of petrol and the amount people gamble. So that goes back to the psychological part of it, where people, okay, it's cheaper, then I can spend more, or our interest rates are going down, I need to start, looking or buy. So yeah, it has definitely made an effect in the market. And having said that, it's not like the market is flying now. It's not like people, are paying 30% and 40% above, the market average. But there's definitely a lot more interest in property, and a lot more people are inquiring to get into the market. And I think partially it's not just this rate cut, it's the anticipation of what's to come over the coming year or next year as well. So yeah, it all comes into play.
Yeah, makes sense, because it's all a long-term game, right? It's the same with the stock market. It's not just about what's happening today. Yeah. People are constantly trying to figure out what might be in the pipeline, or where it all might land, because we've only seen, rates have come down 0.25%. That's not a lot.
True.
Right? especially when we've
Absolutely.
come from a super low rate environment. So with that one rate cut, how much does that affect borrowing capacity? Like how much does it affect how much someone can borrow?
Minimal. Like you're talking about 30K more in borrowing, $20,000 to $30,000 roughly. So that is not a huge amount to, make it or break it. Like that 20, 30,000 was not the reason you're not getting into the market before. But yeah,
Yeah,
like
so
probably
as
if
you
you're a
say,
first,
it's just psychological, as you're saying, and it's the direction of rates.
yeah, absolutely. Like practically, it hasn't got much effect on your borrowing or purchase power. Like, yes, it will take you slightly higher, but $20,000 extra and a house price is nothing. Like you can find something for $20,000 less last year. It's not gonna change how your like purchasing power is. But I think it helps a bit with like first home buyers who are like very stuck at like that $500,000 mark, and then giving them that extra bit. It's allow them to find something a bit more decent and help them to get into the market a bit sooner. But having said that, generally, it hasn't got much effect on the borrowing as such. So yeah, man, like we go back to the anticipation and the fear of missing out and what's to come. Like I know in a year prices will be higher than they are today because rates will eventually drop even further, borrowing will increase even further, and then obviously we'll go back. Go back to supply demand, and yeah, that puts more pressure, and then prices go up again. Maybe, especially in Melbourne, Victoria, like it's been down for a while, and we need some incentive to get the market going again. And I guess it's first home buyers and owner occupiers that will get the market moving again in Melbourne, considering a lot of investors exited the market. So definitely this will encourage that to happen in Melbourne and Victoria in particular. Like you'd know that how most of your clients are buying outside Melbourne, Victoria for their investment properties.
Yeah, it's interesting because there's a perception that property prices haven't really fallen anywhere. But if you look at Melbourne in particular, prices are largely where they were 5 years ago now, right?
True.
And in that time, we've had high inflation. So in real terms, they're actually quite a bit cheaper than what they were 5 years ago. So
Yes,
we might see, we might see the market start to fire up here again, I think.
absolutely. And that's mainly due to blue chip areas where you've got like a 1.52 million average home price. These are the most affected areas, and obviously they affect the whole average of the state. But having said that, there's still places in Melbourne that have done well and didn't drop in price over the last few years. So, but then these blue chip areas are the quickest to recover as well. So it's a quick down, but it's a quick up as well. So we'll see. Hopefully, we've got something, optimistic to look forward to down here in Melbourne.
That's it. And so there's been one rate cut. What have the banks done? Has there been much movement in their pricing, or have they all just basically reduced their rates by 0.25%?
90% did. Some other lenders actually passed on slightly higher. So I know a few lenders passed on like 0.3 and 0.35%. But having said that, they're still within the average of what everyone else is offering. So your owner occ rates now, you're looking at your 5.84 up to like 5.99 within that range. That's your owner occ rates. And then your investment rates, obviously depending on loan amount, LVR, all that sort of stuff. But yeah, from your 5.99 up till your 6.3% investment rates. So they are cheaper than what they were last month. And it's good to see rates in the fives.
Yeah, that's it. So on that point, So essentially, you're saying to people, if their rate starts with a 6, maybe they're not on the sharpest rate. So what should people look at when they're thinking about whether or not they should be refinancing or making a change to their existing home loans?
I think speak with a mortgage broker. Like, it's a no obligation, cost free. Just do a health check. Make sure you're positioned well, structured well. Your rate, your repayments, equity. If you can do something else, all that sort of stuff. So we can look at everything really as a holistically rather than just what your interest rate is and that part of it. So, but having said that, if you don't want to do that, you can just check what your interest rate is and then give your bank a call and see what they're offering and what they can, how much can they reduce it by. So definitely you have to be on the, front regarding making sure your bank has passed on the rate cuts and it has been implemented, which most banks did this time, because it will be suicide if they don't. But having said that, if you haven't got a broker that does that for you, you should be mindful about it and make sure you're on top of it.
You don't have to answer this, but are there any banks you can name and shame who aren't very good at passing on these rate cuts or giving the best deal, giving the best deals?
Not for this time. Not this time around. I can name and shame a lot of banks, but this time they've all passed on the rates, so we're on good terms now.
Oh, very good. Because I know CBA in the past.
Don't go there.
Don't go there. All right.
No, I'm kidding. Go, man.
I know in the past, because they're the biggest, they've obviously taken advantage of their size and they think all their customers are going to be loyal.
Yeah.
So in many cases, they don't give the best deals. Like even outside of home loans, if you just have a normal transaction account with CBA, it pays 0 interest. So, and some people,
absolutely.
like I've come across people who've had a bunch of savings sitting in these CBA accounts, they're earning 0 interest, which is insane.
Compared to 4 and 5% anywhere else.
Yeah.
Crazy, man. Yeah. Crazy.
Yeah.
Crazy.
So the banks, sometimes they take advantage of people who aren't paying attention.
100%. 100%.
And, nothing's more important than your home loan, because usually that's your biggest expense by a mile. So you need to make sure you're on a good deal.
100%. 100%, man. And yeah, like I guess what you do, what I do in terms of educating people, posting on social media or doing the podcast and that sort of stuff. Like if you're listening, you'll definitely, get some good nuggets and, get some good information that you can implement in your daily life. And yeah, it helps. It goes a long way. But having said that, some banks are actually sneaky in terms of what they're doing is, so how they've got their standard advertised rate. So if you check now, let's say Westpac or CBA or ANZ, they've got the standard variable rate at like 7.6%. Okay. And then what we do is we ask for pricing discount, and then they reduce that rate down to, like, they give you let's say 3% discount. Okay. So the advertised rate is 7.8. They give you 3%. It goes down to 5.8%. Now, they will pass the full rate cut of 0.25%, but then they'll reduce the pricing discount. Instead of giving you 3%, they'll give you like 2.9%. So technically, they've passed on 0.15% of the rate cut rather than the full rate cut. But you don't know, you don't see it, because everything in the media or advertisement or whatever says that they passed on the full rate cut, but then they're giving lower discounts. So that's where there's no way you can know as a consumer if you don't have someone to tell you or compare to what others are offering out there. So that's where they always try to play games. But yeah, that's what banks do, man. You can't ask a scorpion why it keeps on stinging. That's the nature. But in terms of, I guess, markets, Billy, I'm interested to know how this rate cut has affected the Australian economy and market, and maybe globally as well, how we're looking, how we're tracking.
Yeah, it's interesting. Like share markets really are just trying to predict the future, and same in the economy. So if you look at the stock market, that's been rising for the last year or so. As soon as inflation peaked, which when was that? 2023? Like it hit, 7-8%, something like that. As
Yeah.
soon as we passed that peak and everyone believed there were no more interest rate hikes coming, asset prices rose immediately. So way before a rate cut. So it's all like it doesn't happen in real time, So
True.
the fact that there's a rate cut hasn't really affected anything because the whole market knew it was coming.
Okay. So it's
And in fact, it came
the
later than expected. So it's not like,
okay.
there's a rate cut and everyone
Yeah.
gets excited. Like we knew it
Yeah,
was coming. We've known
a
it's
year
coming
ago.
for a year. Yeah. And it was
Yeah.
delayed. And now they're saying, they're happening slower than we hoped for. So yeah, so the market hasn't
Okay.
really, everyone
And
hasn't
where
gotten too
from here?
excited yet.
What's the market anticipating moving forward? What's the next year looking like?
Oh, look, I mean, we all know how good interest rate predictions are. We saw that coming
Yeah.
out of COVID when the central bank who control interest rates told us they were going to stay low for a couple more years. They backflipped on that very quickly. So just be very wary of any interest rate predictions.
Absolutely.
Yeah.
Yeah, man.
Like the way it's going at the
Absolutely.
moment, essentially inflation isn't high, but it hasn't gone away. And central bank knows if they aggressively cut rates, property prices will jump up, share market will move higher,
Inflation.
and then the inflation will come back. So that they're just not going to, they're not going to cut rates quickly unless something changes.
Yeah, 100%. And I think this is the right approach, like
Yeah,
you shouldn't
I agree.
be running the economy based on the interest rate, man. Like there's other stuff to do and to look into rather than just working around the interest rate and the housing market. But who am I to say, right?
Yeah, I mean, if you look back at history, when there are a lot of rate cuts, it's usually something that comes up out of nowhere,
Yeah,
or like a big event happens. Like a
like
classic one would
COVID.
be, yeah, like a pandemic, or some sort of collapse in the banking sector, or or
Yeah,
some sort of a
the
war and oil crisis, or it's usually some event happens, and
yep,
then demand dries up, so like inflation drops really quickly, and then the central bank panics and they cut rates to try and stimulate things again.
yeah,
So either the forecast will be right and we'll see very gradual rate cuts, or something will happen and then all of a sudden it'll be
panic.
rate hikes or lots of
Yeah,
rate cuts. Like
yeah,
it's
yeah.
unlikely to be stable for a long period of time, I think. Yeah.
Yeah. Especially in the current, I guess, global environment. Like there's a lot of moving parts and a lot of uncertainty. So yeah, you never know what's gonna happen. That's why everyone's a bit cautious, I guess, in terms of what to expect and how things might go. But yeah, we'll wait and see. Interesting times, definitely.
Yeah, so what do you probably tell clients something similar to what I would, which is worry about the things you can control.
100%.
So you're considering your plan and your family, your goals, what you want to do, etc. And then, okay, what do I need finance for that? Worry about that rather than rates are going to do this and property prices are going to move this way. Like you can't predict those things accurately.
100%.
So
Exactly.
yeah, there's only so much value in it, right?
Oh yeah, you're just wasting your time and energy. And then I don't just tell that to my clients, I tell that to myself as well to remind myself.
Yeah.
Not to get caught up with it, and just focus on what really matters, because it's so easy to get distracted and get caught up with whatever's going on. Like everyone's talking about this thing and then you feel like, oh, I need to have an opinion on it. But nah, just focus on what matters, man. Like you said, just work with the plan. Like people who were skeptical and very negative of the last couple of years in terms of where things are going, and they just stayed out of the market, or they liquidated their investments or assets and then bought gold with them. Great move, like don't get me wrong, but then a lot of markets have actually very well performed over the last couple of years, and it wasn't as bad as it was pictured. So there you go. Like sometimes you never know what's going to happen. And if you want to invest and if you want to build wealth, like you got to take some risk, right?
You got to take action. Yeah.
Yeah, that's
You
the
can't
game.
wait for the stars to align because
It's
everyone's
too
out
late.
there waiting for the stars to align, right? Yeah, and if that happens, property prices would have already moved, right?
You missed out. You missed
And
out.
so on the taking action side of things, what about first home buyers? Has anything changed for them in the last few months?
In the last few months, not as much as like they can borrow a little bit more. Like first-time buyers are in a actually a very good position to get into the market, considering all the grants and schemes available at the moment in terms of helping them get into the market. And like technically you can get into the market as a first home buyer for $30,000. That's all you need, and buy a $600,000 property. So taking advantage of the stamp duty waivers and concessions available, take advantage of the schemes by the federal government, such as the first home owner grant or the super saver scheme, or so there's a few schemes that you can combine and play around with to get into the market with as low as possible. So they are in a good position. The only issue was the borrowing capacity and the criteria. So to benefit from certain schemes, you have a cap on how much earnings you can be making per year. And if you're capping at that maximum earnings, it's not getting you much in terms of lending. So that's where it was a bit unrealistic. But now I think this will help them borrow a bit more, and then hopefully by the next rate cut, that would give them like 40 to 50K extra borrowing. So that would definitely free up a lot more in borrowing to get into the market. But yeah, definitely there's a lot of first home buyers are getting into the market at the moment, and definitely a lot more should actually consider. And that's the thing with first home buyers, usually they're not very aware of their options, and they think that sometimes they can't get into the market because I only have $40,000, or I only have $50,000, or I'm only making $90,000 a year. But in reality, there is options, and you can definitely do something. And it's key to speak with the mortgage broker when it comes to these sort of things, because if you can't buy now, I'll tell you how you'll be able to buy in 6 months or 12 months, and we can put a plan on how to make it work in 6 months or 12 months. So, but it comes back to taking action and, being active and conscious about it.
Have you seen much action from the bank of mum and dad? They've been getting involved in the first home buyers?
There's still a bit happening. There was a lot more happening previously, but we always see security guarantees being offered by parents, and sometimes a bit of cash, helping the younger ones to get into the market, which, to be honest, is fair. Like, I guess there was an article yesterday just showing how the older generation is just getting so much richer and quicker than the younger one, and that's due to the assets and the properties they've got. So it's only fair to help. If you're a good parent, I would do that to my kids when I can. Help them in any way possible to give them that advantage and help them get into the market. So
yeah, I agree. And it's interesting. I've had a few times recently where I've spoken to someone who wants to buy their first home, and I've said, I'm not sure how involved you want me to get here, but have you asked mum and dad? Because every family's different.
True.
Parents are like,
obviously,
we did it ourselves, you do it yourself, and that's end of story. And then others are like, I want to help as much as I possibly can. And sometimes sometimes it does take asking. I think sometimes parents are willing to help, but they want to be asked. They're not just going to offer it up. So true. I don't know. You got to tread carefully. There's a few moving parts with these things, but
they need to.
It can make a big difference, obviously.
Absolutely, and they need to be fully aware of what they're getting themselves into, especially as guarantors, the parents, if they give in their property as a guarantee. Like, they need to be fully aware of the consequences if there's a default, or the bank can go after their assets. But if it's a cash or a gift, then that's a different story. So it comes down to like personal arrangements if it's a gift, or they tell them pay us back in a year or two.
And have you used that first home guarantee scheme much at all? Isn't that the scheme where you can come in with a super low deposit?
The
How
5%
does that
deposit.
work? Yeah, 5%.
So
How does that work?
yeah, you need to 5% deposit, and the government guarantees 15%. So the only point of that scheme is to avoid lenders' mortgage insurance. So every time you borrow over 80%, as you know, you pay lenders' mortgage insurance. So instead of waiting to save 20%, which is not recommended, you can get into the market with 5% deposit, and you don't pay any lenders' mortgage insurance, but you are responsible for a 95% loan amount. You need to make repayments on 95%. And I think it's very important noting that the government is only a guarantee and not an owner. So they don't own 15% of your property. And obviously, when value goes up, loan amount drops down, it's sub 80%, then that guarantee gets removed. But that's how, it's mainly used.
Yeah, there was some strict criteria though, isn't there, about how much income you have and so on to be eligible. So I've looked at that for a couple of clients, and it feels to me like there's a bit of a sweet spot, because like if you're low income, it's all very well getting in with a 5% deposit, but as you say, you still need to repay a 95% loan. And if your income's too high, then you're not eligible at all. So there's there must be like a sweet spot of
it's
income
more
levels
beneficial.
where it's a good idea.
Yeah, 100%. Because as a single, you cap at 120,000 annual income. I think 120 or 125. But then as a couple, the cap is 200,000. So as a couple, first-time buyers, you can borrow a decent amount on a combined income if you're making 180, 170, 190, 160. That will get you the borrowing you need to purchase up to like 750, 800,000, and can still benefit from the 5% deposit. So that's where it really comes into effect when you're a couple looking to benefit from the scheme. But as a single person, it limits you where you're only like capped at like $500,000, $550,000 purchase price.
Cool. And another question for you. Where do you sit on fixed rates? Are you fixing many rates, or is it just not necessarily a great time to do that right now?
Yeah, look, I'm not for fixing at the moment personally, because I believe rates will drop even further. And to get a half decent fixed rate, you need to fix for 2+ years. So if there was like a 1 year decent fixed rate, probably it's a possibility to fix, because by the time rates, like if you're looking at the difference between current lowest variable rate and the current lowest fixed rate, if you're fixing for 1 year, it's very similar, fixed and variable. Okay, so there's no point, because you're not saving anything, and it's a downward market where rates are expected to go down even further. So you don't want to fix and lock yourself out of that. But if you look at 2 years, the difference is like 0.5%. Okay, but then if rates drop by 0.5% within the year, then there you go, like you're already there. And then you've got another year. What if rates drop even further? Then you're going to be missing out because you're locked for a couple of years. So that's where it's a bit tricky, and I don't see much benefit in it, because if rates drop by 0.25%, the fixed rates will drop even further. So maybe then you can consider fixing, considering we've had 2 rate cuts now. We're probably not going to see another 2. We'll probably see 1 more. So look, it's not black and white, and it comes down. That's why I don't tell people to work as guessing, or it's not betting. It's what works for you. Do you value consistency and predictability over potentially missing out on lower rates, or you're fine with variable rates? You're happy to ride the wave and see how that goes and benefit from doing extra repayments and all that sort of stuff. So yeah, it's It comes down to the clients, but then I haven't had one rate fixed in the last. I had actually one rate fixed in the last year.
Did they insist on it?
There was a very good offer that came out 2 years at 5 point. I think it was like 5.4 something, and rates were still like 6.2%. So it was like, let's fix it because they're not going to drop more than 1% over the next year. And if we manage to do that and then benefit like a 1% lower over a year, then I'm already in credit if they drop even further for the year after. And yeah, we just took that offer. But yeah, that was the only one. I don't know if that
Cool.
made sense.
Yeah, that makes sense. I mean, from what I've seen, there was one good time to fix rates, and that was when they were at 2% fixed.
Yeah, that's when you should have fixed it for 10
I've
years.
had a few clients who are still coming off the rates just recently.
I know, man.
Bit of a shock to the system, but yeah, that's the only time I ever really remember seeing that fixed rates were clearly worth looking at.
Yeah, during that period, 90% of my clients were fixing. I was like, you have to fix your rates. You have to.
They couldn't go much lower. I remember there was some people at the time saying, well, they might go lower because I think Europe, I think in Europe they went negative, right? Like the central bank there went negative. So I guess it was possible, but it seemed like a pretty good deal at the time.
Exactly. And looking at it now, like should have fixed for 15 years, even though you can't. But it's just good times. But we're paying back for them now. So I think we're variable rates, like a cash rate of high 3%. That's like a healthy cash rate where like your mortgage rates are high 4s to mid 5s, that range. Like that's okay. That's decent, you know. Where they were like now, where they are still now, like they're still not cheap, and where they were over the last couple of years. Like that was a killer, man, especially with what the average mortgage is at these days. It's not, it's a big payment that you have to do.
Yes, but the RBA even said that in their last release. They gave a pretty strong hint that they want to cut maybe another 1% or so. And that feels like where it should settle. Where we want it to settle. So 4.5%, 5% mortgage rate.
True, man.
I've got people who are asking me about rent vesting. Do you get involved in people doing that, or many of your clients doing that sort of strategy?
I'm actually considering that myself now. So
so am I. So am I.
So yeah. Look, obviously it's got a lot of benefits. The only downside that I can think of is the uncertainty in terms of having to move out after a year because they want to sell the property, or then having to move out again, especially if you've got kids, school, all that sort of stuff. That is the only part. So if you're willing to take the risk and just, you know what, like I'll find another property if I have to move, then by all means, it's a great strategy because for several reasons. So it can be for lifestyle reasons where people, they just want to live where they want to, but also from an investment point of view, like if I sell my owner occupied property, okay, because it is in an area where it's not going to grow much more over the coming 3 to 5 years, all right? So instead of wasting or missing out on potential capital gains, I'm selling that property, I'm renting where I want to live, so I'm ticking the lifestyle box option, and then I'm investing those funds in other states and suburbs where there's big potential for big gains over the next 3 to 5 years. So that's where I'm coming from, and that's where I encourage people to look at it when it ticks those boxes. But if you're just selling, so I get people, they want to sell their house because they want to save on like they want better cash flow. It's just too much, the repayments and all that sort of stuff. I'm not a big fan of that strategy because you need to go through, you know, the rough parts, and you need to force yourself to make those repayments, and then your future self will thank you for it. So if you're just doing that, I've got $3,000 extra now to spend on rubbish, then by all means, this is not the right thing to do. And you see that as well, in your profession as well. You need to commit, I guess, to make it somewhere. You need to force yourself to do things you don't really enjoy doing, but in hindsight, your future self, will thank you for investing and doing the right thing.
Yeah, agreed. All right, a couple of rapid fire questions here that I've just come up with before we sign off. Just because I get asked these things a lot about finance brokers or mortgage brokers. Firstly,
Yep.
how do you get paid, and how much does it cost if someone wants to
So-
use a mortgage broker?
Most mortgage brokers don't charge, and we only get paid through the lender, the bank, as a commission, and that commission is usually declared in the credit proposal when we send that out. So everything's outlined in terms of how much we're getting paid. Having said that, a lot of lenders now pay the same commission. So after Royal Commission, most lenders were forced to pay a similar commission. So that doesn't give the broker, like a favorite lender to go
Like
with.
an
just purely
incentive
based-
to use one bank over
Yeah.
another because they get paid more. So you get paid the same, no matter
100%.
which. Yeah, and like how many different lenders do you have access to?
50, 60.
50 or 60.
Yeah.
Yeah. That's So people still don't understand that all the time. Like they'll just call their bank and be like, "This is my bank. They'll do my loan." It's like,
Yeah.
you're ignoring 50 other lenders, and the bank's not going to be loyal to you. So I would recommend that you're not loyal to them and just get the best price.
100%. Exactly. Like, look, I'm a mortgage broker, so probably I'm biased, but I think it's one of the best services out there because it's not costing you anything. If anything, you're saving heaps of time and hours. And obviously, look, it comes down to the service that the broker is providing. So if it's with like anything, like there's good brokers, there's bad brokers, just like there's good doctors and bad doctors, just like there's anything good and bad. So if you find yourself a good person that you connect with, that they look after you and they're doing the right thing, it's a huge bonus because you don't need to worry about all that sort of stuff. They do all the work on your behalf. They're getting paid by the bank, not by yourself. And that commission is not added to your rate or offer or anything, like we will be getting similar rate, if not better, than if you go to the lender directly. So it's a no-brainer to me. But yeah, I guess it's reflecting like almost 80% market share now with the brokers. So 80% of people getting finance, it's through brokers now. So this is a reflection of people more and more understanding the role and the benefit and the value that a good mortgage broker can bring to the table. So
yeah, spot on. I've seen the work you do and how happy all my clients are, Eddie, with your work. So grateful to have you here, and thanks
Billy.
for joining me on the podcast.
Thanks, man. Thanks. It's a pleasure. It's a pleasure.
Yeah, awesome. So we'll wrap it up there. If you enjoyed this episode, please make sure you rate us 5 stars on Spotify and Apple Podcasts. You can check out the show notes for for Eddie's podcast as well. The Brokers Lounge, we'll have a link to it there and how you can connect with him. And if you need personal finance or mortgage advice, please book in a chat. Again, we'll put a link in the show notes, and see you next time on the Winners Playbook.
Thank you. See ya.